Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. I'm your host Andy, and today with me is Radboud Vlaar. He is a managing partner at Finch Capital, a VC investor based out of Amsterdam. Radboud launched Finch Capital and its first fund in 2013, and before that Radboud was a partner at McKinsey Company, focused on financial services, private equity and M&A. Before McKinsey, Radboud worked at TPG, where we had Rayan Sean as another TPG alumni on the show a couple of weeks ago. Radboud also co-founded 3 companies and holds no less than 4 master's degrees from the University of Groningen. Today's episode is all about investing into fintech companies with a focus on Europe. We're talking about investing into B2B and B2C startups, especially into AI for the financial sector, and how Finch Capital uses machine learning algorithms to source their deals. We also talk about how VC investors compete for deals and what they bring to the table other than just money and how they're adding value to a startup. And then we talk a bit about the history of Finch Capital, how they started out, how they raised funds themselves, how they invested, and how they changed from their first fund to their third fund. And then Radboud tells us a bit about his lessons learned from nearly 10 years of investing into startups, which is super interesting. And then, of course, last but not least, he gives us some career advice. So I hope you enjoy the episode. And now, without further ado, my episode with Radboud Vlaar. Radboud, hey, welcome to the show. It's a pleasure to have you here.
Thank you for the invitation.
So you have founded Finch Capital in 2013, and could you tell us a bit about why did you found the company and when did you start and what were the ideas behind it?
Yeah, so I worked 10 years at McKinsey and was active in the financial institutions space as well as in the private equity space. Always had a passion for new products, new innovations, or building new companies, businesses, also within the large corporates, of course, which was a lot of my advisory work at that time. Also like the entrepreneurial part. And so that's when, and actually as a child or student, was most interesting in investing into companies. So that was always an idea what I wanted to do over time. And what you saw in that period is after the financial crisis, a lot of focus of financial institutions was inwards. While on the other hand, if you looked at data, you saw that a lot of the consumer and customer behavior was changing quite a bit. So they were increasingly moving to online channels, mobile. So if you take the period 2002 to 2012, in Northern Europe, 50% of the branches were shut down, partly to save costs, but partly also because consumers were no longer in that much need. So you saw in a lot of areas, you saw a change. And I think Europe's history in venture capital was mixed. I think for a long period, Skype was the main success people could talk about. And what we found is that, as the hypothesis at that time, is that in financial services, Europe has a very strong history of innovation. Europe also in adapting new technologies was in the forefront. Like in the US, they were at that time still opening branches while using technology to interact with your bank or with your insurance company was already more adopted in Northern Europe than in the US. So the hypothesis was that for financial technology, Europe could be a very good platform and also very attractive with more homogeneous regulation across Europe. Okay, nobody forecasted the Brexit at that time to happen. But so all of that combined was basically the underlying thesis for the opportunity in financial technology.
And with Finch, as you said, you focus on fintech investments in the VC space. Can you talk a bit about what is the background of the company? So how much do you invest? Like what kind of companies are you looking at? What is your focus point?
Yeah, so like any company, nothing is as dynamic as the investment focus. I think what has stayed constant and consistent is the focus on and the definition of financial technology. So on the one hand, it's the very broad range of financial services. So from payments companies to insurance, to banking, to asset management, private banking, intermediaries. So the whole value chain of financial services. And then we focus on two types of, call it technology companies. So companies that try to disrupt. So they try to become a mini bank or a mini insurer by taking away customers from these players. And on the other hand, companies that sell software and technology into these companies that are active at the moment in financial services to make them faster, better, more efficient by using technology. So it's that combination. And initially we had in the first fund a very broad focus. So we have invested in companies right from the start. So in the seed phase, so with very few revenues, to companies that were in the tens of millions of revenues, with most companies around 500,000 to 1 million revenues. In Fund 2, we started to invest as of 500,000 revenues, and the third fund, out of which we're investing now, is more in the 2 to 5 million. So in Fund 2, I would say we invested between 500,000 to 5 million in revenues, and now we narrowed that a bit more into the 2 to 5 million range. And then we do tickets to get to an ownership of around 30%. So our tickets have evolved in Fund 2. I think it was between 2 and 7 million, and probably it moved up now a little bit more to the 3 to 8 or 3 to 10 million. And then we continue to invest in the companies as they need funding for their future rounds.
I'm not an expert in VC, but I feel like 30+% is fairly high in the space. Am I mistaken there? Or what's the reasoning behind why are you looking at that percent? Why not 5 or 10? Why not? I mean, above 50, I think it's pretty clear, right? But is there any reasoning why around 30%?
Yeah, so we used to invest 15 to 25%, which is more the normal percentage for a lead investor, so someone who does the majority of the round. And if you go below 15%, it gets too small, because how the business model works of a venture capital investor is that a few of the companies drive the outlier returns. So differently to the buyout sector, where every company you make a little bit of a gain, but you try to not let anything go bust or lose money. Here, it's 20% of the companies determine 80% of the total value creation. And if you then own 10% of that company instead of 15% or 20%, it is much harder to make very high returns here. So that's why a minimum ownership is needed. Now, the other thing is what we see in Europe differently than in the US. Like if you take unicorns or decacorns or any, Europe just has less of the multi-billion companies as outcomes. And most of the companies which are successfully sold are somewhere in the 100 to 500 million. So in order to get to the same absolute outcomes, also every time we have a slightly bigger fund, a little bit more bigger ownership makes it easier. And what we typically do is the majority is primary, but also secondary, as there are sometimes angel investors, former employees that want to sell off some of their shares. Then we do try to find a combination of new money and buying out some existing shareholders that would like to take some money off the table to get to that percentage.
That's a fairly detailed question, but I think it's really interesting because I haven't spoken about this a lot. How well is it received from a VC like yours if people want to kind of get out of the company? You are a Series A, Series B investor, if I'm correct. So how common is it? And then how do you try to get the percentage, right? How much money do you want to give the company to further their growth? And how much money do you say to get the capital holders in place?
Well, I think the primary focus of both the company, the investors in the company, and the new investors in the company is to make sure that the company has sufficient cash so that it can grow and create values. So I think if that number is X, if that number is 5 million, 8 million, 10 million, then that's the number. And typically you look what is needed for 24 months, ideally, or 18 months, but somewhere in that period, so that you don't have to start fundraising as a company the moment you just closed the last round. So that is the first, call it, number. And then there is a question, what is the ownership you get for that number? Is that what is of interest? Now, what you see in a lot of cases that there might be some people willing to sell. And if there are investors that are also willing to put more money in, assuming the company has sufficient runway, that can be facilitated. So I think as long as the company doesn't have sufficient capital and cash to grow the business, I think a secondary is not part of the discussion. So it's more if we, for example, would like to invest more than that the company needs, that can be a way to actually make some of the existing investors happy that would like to take some money off the table, and some new investors happy, maybe have a minimum amount of capital they would like to deploy. Like if you are getting fund sizes that are getting bigger and bigger, you'll have to, on the one hand, there is a certain amount of capital you have to invest. On the other hand, there is a limit to how many companies you can have as a fund, because you just have a limited set of partners and principals that can be on the board. So there is also a scarcity of human resources to manage these companies well. And that's why sometimes you would like to deploy more money into a company than a company would like to take. And then secondary can be a good answer for both people. But if people desperately would like to sell and get out of a company, that is on itself not a good sign. So if people say, hey, I would like to raise money and half of my investors would like to sell the company, then that might scare new investors. But if there's like 3 or 5% of investors that, for example, are angels or friends and family that have been there from the first day of investments, and it's now 3 to 5 years later, I think it's not strange.
That actually would have been exactly my follow-up questions, how it feels like if there's like kind of a threshold where you say, oh, actually, like if 10, 15% of the previous investors want to get out and like they like want to give their shares away, then you're like, I'm getting a bit wary. But if it's like only 3 to 4%, then it's like, yeah, it's like totally normal, right? It's just they want to get out. It's out of their league now, or it's out of the stage that they are looking for.
Yeah, but we have seen different stories. So I think you see either people that have gone bust or are in financial distress and they made some private investments, so they're in desperate need for cash. So most of these secondaries come at a discount. I think about 20, 30%, 15% of the last round. Or it could be that people pass away, human tragedy. So there are like a lot of stories. If the investor in the last round is institutional and there's no, call it, real explanation besides the party not being very keen on continuing to hold shares, that's typically a red flag. But so it's typically more smaller shareholders whose core profession is not investing in companies, but for some different reasons would like to create liquidity.
Mm-hmm. Yeah, I guess it's always a game of like looking at how does it fit into the bigger context. Now, I saw a press release of yours and you said that the latest fund you raised will focus on AI technology, right? Why is that strong focus on AI, and what's your reasoning behind why not, for example, there's other upcoming technologies, blockchain or anything else?
Yes, so we focus on multiple technologies. If we look at the two sides, so the disruptive side and the call it the other side, we focus on our software companies or technology companies that help financial institutions to transform. We see there a very strong need for technology companies that make a use case for financial services that use AI. So I think AI is a little bit like a buzzword, like the internet or the World Wide Web. Our view is that AI will be used in some way or form by lots of the companies going forward. There's a way to do things smarter, more efficient. And if you look at the financial sector, there's lots of data available in this sector. There's a lot of manual work and there's a lot of inefficiency that can be improved by automating either repeat processes and smarter use of data. So our view is that software companies that have a strong use of AI will be better able to help the financial sector and have better products to help them, whether it's needs and customer insights, productivity, or whether it's tools to help to make investment decisions. But that's basically why the strong focus of AI, because we think it's going to be embedded, and 8 out of 10 software companies that help other traditional industries to change will use some way or another AI.
Interesting. Now, I saw when I looked into Finch Capital that you actually use AI for deal sourcing. Can you talk about this? I think it's called flow rents.
Yeah.
This kind of, I found it really interesting because I thought especially VC deals are not like very high in data, right? There's like not so much data there, but how are you trying to source deals by leveraging AI yourself?
Yeah, so I think if you look at our case, it's how we use it. It's not to, at least we don't see a situation where the tool provides, if a deal comes out of the tool, automatically that company is sent a term sheet and asks for, with an amount, evaluation, terms, and is asked for countersigning. So it will not replace the work that is being done, but it will help to tap into and generate a list of companies that are worthwhile to meet, have a talk with, and find out more about. And I think there's a lot of data about tech companies. So if you, for example, start using the data of angel investors or seed funds, there's a lot of data published on databases like Crunchbase, newspapers, and you figure out the parameters. So in 2020, a lot of the months have been used to fine-tune also the quality that comes out of it. So it's a machine learning tool. So it requires input from the human to get it right, but it's basically leveraging a lot of the data out there. And a lot of startups are, even if there is not a lot of data filed by them, a lot of them have some form of a press release or get an award or get something. I think if you're not able as a startup to get into any news, but you're very successful, especially the phase where we focused on is the 2 to 5 million revenues. By that time, companies that are there should have had some coverage. And where it helps us is to get a complementary set and partly an overlapping set of companies that fit within the focus where we invest and maybe wouldn't have been on our radar without the tool, or maybe they would have, but maybe we find them earlier now. I think also where the comparison is not completely clean is basically we started using it we developed it almost at the same time or just before Corona kicked in. So maybe otherwise on conference lists and other platforms, you would have found some of these companies, but first it's a very efficient way. And so far has proven to good quality. We haven't made any investment yet in a company there, but it's also, we have been working a lot on tuning it. But now I would say roughly 20% of the companies in our shortlist, which we discuss and track in our investment committees, are coming from it. But I think it will take some time. At least we're earlier on finding a good set.
Yeah, I mean, that's typical with machine learning algorithms, right? They need time, they need more data. And how does it work? So you track Crunchbase, you track news sites, you track announcements, and then does the program already sort like this seems to be the top companies that you should look at, or it just like gives you a huge...
Yeah, it generates a list of the companies that have the highest match with basically what we're looking for. And so it generates a list of companies that then someone in our team scans through these companies. So you have to look up these companies if they're really interesting. And that's why we also becomes better and better. And out of that list, let's say if you get 20 companies, probably 2 or 3 we then really find interesting. So that's why I said, based on our experience, not be that the point the machine produces a term sheet because it's so good. Still, you would like to speak to the company and get a bit more color because there's a lot of data not publicly available, but at least it brings another set of companies that we haven't found. And there's, of course, a lot of data. Take about LinkedIn, you can find how many employees, how much was the employee growth. You can find other data about downloads and other statistics. So you get a bit of a sense whether the company has a strong momentum. Like companies that grow super fast but are not hiring anybody sounds a bit a mismatch. So you get a sense then if the company is successful, and that you can do all with data, but still also a lot of things which are explaining something. So some companies might not have been growing that fast because they maybe use third parties or they have 2 different entities, etc., or it's fragmented. So it's always important to get the story behind it, but to get a first filter, it works very well.
And then say you arrive at those 2 or 3 companies out of 20 that you like from the website that look interesting. How do you then proceed as an investor to reaching out? I've heard a lot about the other way around, right? The founder trying to get an intro to the VC, and that's, they always say like you should have a hot intro, you should have a warm introduction, and then it's much more likely to get the call. But for you, is it also that you want to you check your network if somebody knows the founder, or is it more like you reach out directly?
Yeah, so I think the way we do it is probably very similar as a company. I think with the big difference is that I think if one founder asks another founder to reach out, in a lot of cases, they're not competing. But if we would ask another VC, hey, there is this super amazing company, can you make an intro? Yeah, at the end of the day, there's typically one lead investor. So in a lot of cases, it would be if there's a seed investor we know very well, they could make an introduction there. Or it might be that there is another company where we see founders that know each other, then we get introduced via this other company. So ideally, you try to get an intro out of your network. But if not, we can also reach out. At the end of the day, I think there are not that many VCs. So I think we're in a slightly different setting, like probably there are 10, 20 VCs that are a good fit for that company, given industry expertise or country expertise or business model or other aspects. So it's maybe easier rather than sending cold emails to a VC by a company and then being one of the 3,000 cold emails.
Yeah, I guess you are in a much better position, supply demand there than most of founders.
Only not very attractive for a venture. Like for us, it's about making sure that we don't miss this 1 or 2 or 3 great deals. So a company that is doing super well, yeah, if another VC gets a warm intro from an angel investor or another seed fund that knows them very well, there's more comfort. So it's as important for us as for a founder to a VC to do this well. But maybe if we don't know someone and we're early enough and there is a hook and an angle, how we can show that we can add value, or we have companies in our portfolio that are of interest to that founder, then typically it's also an easier way to do that more coldly.
You touched on something interesting, how you add value. How often do you see yourself kind of competing for the deal, and what is your value proposition, right? I mean, in the really good deals, I think both sides kind of pitch to each other, if I may call it that, right? On the one side, the startup wants the money, right? But on the other side, the investor also wants the deals. What are like some typical things that you would say to a founder, hey, if you work with us, this is what we could provide for you aside from the money, right? Because I feel like, at least globally, or what I'm hearing from the US, money is getting slightly more abundant. So kind of soft skills or soft facts seem to increase in value, but please correct me if that's not correct.
So I think there is a difference in the stage of the company. So I think if companies have hundreds millions of revenues or 50 million, I think there is already a difference, the role the value add plays versus the valuation and the capital. And then there's very early on, in the early days, where of course, if someone can bring extra clients, if someone has a network or a deep expertise, it can help a lot the acceleration of the company. And so there are the firms that have a lot of logos and a track record of having IPO'd 25 companies. So there is much more tangible what a track record is there. If I was a founder, I think it's very important who within that firm you work with, as probably there are different styles and different personalities. So checking that. But overall, these firms can help is clear with the network they have. And in a lot of cases, what we do is the best references with the companies we have invested in, because every firm will tell, we will help you with ABC, we will do this, we will do that. So did people really do that? So we have a very large network of financial services, a lot of financial experts. And I think by speaking to the portfolio companies and the founders and CEOs of these companies, I think you will get a more color around that, what it is. But value add in combination with sector focus and sector expertise is where we try to differentiate.
We covered how you partially source deals via this AI-based tool. How are the rest of the deals sourced currently?
Yeah, so like I mentioned, there's a large volume coming via inboxes, emails, quite cold. I would say almost all the investments we have done are coming indirectly or directly out of people we know. And there might be a bias is that we are one step ahead and versus the ones that get it cold email. So that's why there's a higher conversion. And also around that, if you get introduced, that the party that introduces you has a good feeling that there could be a good fit based on personality, investment criteria, and what is needed on both ends. Plus, probably good founders and good entrepreneurs do an effort to get a warm intro rather than a cold. And probably good entrepreneurs are better networked than average entrepreneurs. So there are probably a lot of factors that play a role. There might be biases that we get better due diligence input prior to the company or timing, but overall the majority is via people we know. Let's say if you would look at it in the LinkedIn definition, are a first or second connection. So there's always one person we know well that they know well.
Now looking at the funds you raised, I think you tripled the size of the funds threefold. So was there any, I guess there was, but how was the difference between when you just started out in 2013 versus how you get them now? Did still came a lot of inbound because you already had a network from your experience at McKinsey, or was it more that you kind of had to get to the startups, had to reach out more and had to like hack your way around how to get on the good deals?
Yeah, so I think it's not some things changed that are positive in that dynamic and some things that are making it more difficult. So the thing that make it more difficult, I think when we started, people didn't really knew Fintech was not a buzzword like it is now. So we were one of the few Fintech funds. I think Fintech has become more mainstream now. So that differentiation is still there. But like in the beginning, we were really one of the few focused on Fintechs. And I think you also at the time, there were not that many Fintechs. So we basically grew with a lot of these entrepreneurs. I think the more you're known, the more companies you have invested in, the more investors you have worked with. That is basically expanding your network. It's also clear where you stand for. I think also if you're in the third fund, you're more likely to stay here than you raise your first fund and then disappear. So net, it's easier, but also there are lots of more Fintechs at the moment than there were before. I think overall, there are also more investors. I think there are some US investors that have come to Europe. There are some more corporate investors that started to focus on this. They're more local, so it is a more developed ecosystem than there was in 2013-14.
This brings me to an interesting point because I just recently talked to Brett King, author of Bank 4.0, and he said when he started his challenger bank, in quotation mark, Moven, it was in 2010, and there was not really, as exactly what you said, there wasn't really a big fintech world out there, especially in 2010, is even 3 years earlier, right? When do you think this, or when would you put this trend, when it really started to take off? When did it really start to be fintech?
Yeah, so I think there may be two sides of that. So one is a bit, what do you define as fintech? And why do I say that is, if you look at the capital ones, the ING Directs, take the stock brokerage firms like the Binks, the Swiss Quotes, like there have been a lot of startups, or in Germany you have Interhyp on the mortgage side. So there have been a lot of new business models, and a lot of them have been either been acquired or incubated out of startups. But there were, I think, somehow not seen as fintechs, because I think a lot of them have also been founded by people that know financial services well, like mature bankers or insurers or businessmen. I think what changed a bit on the fintechs now, I think, there are a lot of also more younger generation of people maybe that haven't worked in financial services that have started this. And I think the adoption has been way more and much more mobile, playing a role than it was before. And a part of that is that I think first people needed to start sending an email to each other. You're not going to do your financial services online if you don't even trust to send an email. Then the smartphone adoption was needed. And I think when that network started to kick in, that people were all online. And I think the financial crisis also helped with it, where a lot of financial institutions were inward focused rather than investing a lot of new money into innovation. As I think a lot of fintechs have done great, but if you look at a lot of them have changed the UX and improved the customer experience, but fundamentally are still solving a similar customer need or bring a similar product to the market, which can be cheaper or can be better. But who knows? If there was no financial crisis, financial services could have made some of these investments or put more resources at work to do it themselves. So I think it's a combination of that. I think it's the type of entrepreneurs that do fintech, and I think there's the whole everybody being online and digital and able to really have more mobile-led and pure digital models. I think a lot of the models before were more hybrid. They had some branches in combination with the internet, and now I think you go to the more pure digital models, which scale much faster, and therefore, like if you have to open every time a branch, takes much more time than one website or one app in the App Store.
You said there's now more people from outside finance founding fintechs. Why do you think that is? Do you feel like there is just a lot of room for innovation there? Is it a very attractive field, or what do you feel drives people currently into fintech?
Yeah, so I think if you look at the most successful fintechs, I think they some way or another have worked somehow in financial services. So they have a bit of affinity. But in general, I think they're more younger than the generation that did that before. I think there are lots of people that have, as the world moved digital, experienced the gap between their experience on sending messages or doing things online in their normal world versus their financial world. So they had great difficulties figuring out what the best mortgage was, or they had great difficulties finding an insurer that was more flexible than something where they need maybe for a week a car insurance instead of for a year. So I think as a lot of the traditional products enhance their customer experience and flexibility and pay when you go type of models, I think people also saw the gap with the way they bought and used financial products. So that probably inspired them more, whereas the older generation maybe was not adopting that fast to digital products or didn't see the value in that. So I think it's a lot of experience gaps people see between the two worlds.
Can you name an example trend within fintech? Because as you described, fintech is huge, right? You can talk from mortgages to, I've worked at FIS before. They do fintech for over 50 years now, right? Do you see some particular trends? For example, you said you do B2B, but also D2C, like business to business and direct to consumer. Is there any overlap of one of the two businesses, or is it evens out? Half of the companies are consumer companies, half of it is business, enterprise software, or?
Yeah, so I think in B2C, you see a lot of companies that work with partnerships, so have become B2B2C, as marketing is quite expensive. So a lot of them are developing products that have a great customer experience and solve a real problem, and then use some of the other parties that have large customer bases to basically bring these products to the end consumer. I think a lot of growth is in the B2B space because there's a big demand also by the established financial institutions to use technology to adapt and transform themselves. So that's where we see a lot of growth. And there are some areas that have grown a lot, of course, due to the corona, where people see, for example, that digital onboarding has got a massive boost. The same as that remote working and productivity tools, I think, have helped the corona lockdowns and working from home shift have helped a lot there. But there are so many areas, and I think the financial sector is typically 20 to 30% of a country's GDP. So it's huge in terms of volume, but even if you take already the rental space or the mortgage space, there are a lot of different subsectors in that where efficiency improvements can be made. And that's the beauty of financial services. Some of the small improvements can have a huge impact financially for the value chain. And as a result of that, if you can save a lot of money, you can also charge more money.
I want to switch gears a bit now. And we talked a lot about the sourcing, the investing. I'm a bit curious how it works on the other side, because I read in one of your press releases that I think 90% of your investors did a follow on investment. And now I just did my Kaya. So I'm like curious, how does this work in real life? Do you take on most of your current funds from old investors, or do you get new ones? How does this process work?
Yeah, so if you want to have a larger fund, typically you need also some extra new investors. Then, of course, there are investors that continue, but maybe with a less amount of money, because money in the industry where we are active is for a relatively long period locked up. So a fund lifetime is 10 years, and you get typically some early on exits, but typically a lot of the best companies you hold longer in your portfolio. So that means that by the time you raise a next fund, the money of the previous fund, a significant part has been called. Basically is that we ask the investor to wire the money to us because we make the investment, but not returned yet. And therefore, institutional investors have certain limits of how much they would like to deploy in the asset class. Some of them increase when you do a next fundraise, but some other, if you think about family offices or high net worth individuals, they could have certain private situations. Some people buy a house, some people get separated, some family offices have generation shifts where there are new people managing the money with different appetites. So there are always shifts in terms of how much people would like to allocate. But overall, we're very pleased with a loyal investor base that has continued to invest. And then we always add new investors to our fund as the funds grow bigger. But probably the future funds, I'm not sure how much bigger we will get versus what we are now. I think because if you want to have very strong returns, the bigger the fund gets, sometimes it doesn't make it easier. So we feel the 150 to 200 million is a good fund size. Maybe 250 over time, but more in that space.
You touched on a point that I read and hear a lot about, right? You can't infinitely, especially in the VC space, right? If your ticket size is somewhere, and I'm just roughly 5 million, right? If it's like 500 million fund, that's more like a private equity fund, right? Where you deploy tens on like dozens of millions of dollars. But if you just have a 5 million ticket, you would have to invest in 100 companies, right? That's just like very hard to manage.
Yeah. So what typically the funds do that have the 500 million funds, they also invest in the growth rounds. So if you would look at the Series D or E or F, as each of the rounds is a number. So when companies start raising like 200 million or 50 million, so they write the bigger tickets, which are companies that are typically more mature. So they have already more revenues and have a shorter time to exit. I think some of these funds have done very well now with the recent IPO, or not recent, I think a pretty good IPO window we have had so far, and attractive valuations at the stock markets. So you can deploy quite a lot of money there, especially in the US. I think Europe has less of these very large growth rounds, plus some of these companies want to expand from Europe into the US or from Europe into Asia and might look for investors that can help them in that region. But there are a couple of the 400 million plus funds in Europe, but you either need a very large team or you need to be in combination with being a bit more flexible, that you also do the more later stage funding rounds.
I'm repeating a question from earlier, but from another perspective now. And that's basically from your first fund to your latest fund. How did the fundraising for you change? Did you just then try to keep you said that you have the follow-on investors, right? But was it harder for you in the beginning to raise money, especially for a field like fintech that basically, as you said, didn't really exist, right? Like what kind of investors are the ones that like look into those niches that are not established? I guess today, if you say, hey, I'm raising money for a fintech fund, it's like everybody knows what it is. But in 2013, if you say I'm raising money for a fintech VC fund, they're like, what's that, right?
Yeah, so I think if you look at the investor landscape, a lot of large institutional investors like bigger funds. Like if you are a pension fund or insurer and you have 50 billion of assets or 500 billion of assets, and you need to deploy every year 2 billion in private equity, then a venture fund with a fund size of 50 million and you don't want to have more than 10% concentration limit is not very attractive to deploy 5 million. Then you need to do every day 3 funds to deploy your money. So that's why you see if you're on the smaller end when you start, and because you don't have a track record, the only way is to are people basically that somehow know you, trust you. So it's like if we look back at who invested in our first fund, I think we spoke to lots and lots of investors, but these were the investors that directly or indirectly knew us and had a trust in us that we somehow were going to make that work. Now, as you go to fund 2, there is already a little bit more of evidence what you can do and track record, so that develops. I think The easiest is probably Fund 4, or the hardest, you will not know. Because in Fund 3, the amount of realizations, so you can have a great track record on paper, but at the end of the day, the question is how much cash did you really return to the investors? That, if you look at most of the capital is returned between year 7 and 10, and you start raising Fund 3 in year, let's say 5, 6, at the time you're at Fund 4, there should be a lot of more proof whether what you thought was going to happen did happen. And there is quite a lot of institutional money that looks for more proven realizations. So I think overall we have been lucky with the team and the performance as well. As a result of that, in the beginning, of course, we had to learn also a lot with that. And as you become bigger and there's more track record and more data, fundraising becomes easier if the track record is good, which we have luckily in the case. But realized track record is going to help even more so. And then a certain fund size, now the 150 to 200 million is still on the lower end for most of the institutional money, as they would like ideally 200 million plus.
And I want to change gears a bit, but you can also relate the following question to fundraising, to anything in your career, in your experience. What were some mistakes that you now say, actually, I'm glad I made those mistakes because they helped me in the end? And what was the best experience you took out of a mistake that you made?
Yeah, I must say I've learned from all mistakes, or at least I think there are mistakes which you wish they didn't happen at that time, but you also learn from it. Either you don't make the mistake twice, or you get some early warning alarm bell developed in your brain that the next time you get there, it rings. So I think I wouldn't say mistakes, but the learnings maybe we had is we invested in certain companies where we probably were not the right investors for these companies, and these companies and the team were not the right investors for us. So I think a lot of areas where I think are people mistakes we have made, and call it maybe judgments on people, where either they were amazing in creating a vision and telling a story, but not in executing it, or not great in hiring the right people around them. I would say we have had very few business model or adoption mistakes. There's very little of that. So it's much more on the execution. And I think there's a balance between being stubborn, because you need a bit of stubbornness as a founder, because everybody will tell you not to do it. So if you listen to the advice, then you will never start up a company. But you also need to be able to listen enough to figure out, hey, this is not working, I need to adapt this. So what does it take to win? And therefore listen to the feedback of clients and people. So there was this fine balance of listening, I think, where a lot of things we learned in founders that were too stubborn or not listening, or not able to hire the right people around them. And timing, I think the mistake we will continue to make and have made is timing, like investing too early, investing too much too early, stopping to invest too early. And to get the timing right is probably destroyed the most value and created the most value. And the lessons there with timing is, when do you stop basically believing in it, and when do you need to give sufficient time to make sure that you didn't pull the plug too early or jump too quickly to a conclusion. But this timing mistakes have been most insightful with hindsight, and are probably also the hardest. So every time you get better in it, as every company is its little pilot with everything slightly different each time. The founder is not exactly the same. The market is not exactly. But I think probably if you look back when you made the mistake on timing, you see, what did I miss as a signal where I could have seen that actually things were going better or not. And the same is when to exit. You probably sometimes exit too soon or exit too late. Look at the stock markets. I think you could say the listing, if you take probably Europe's more successful companies, did companies like an Adyen got IPO too early? Or if they would have IPO'd later, they could have had a higher proceed for the investors, as some probably were forced to sell the moment a company is liquid. So at the end of the day, some things are a success, but there are also lots of examples where people just IPO'd on time before the whole market collapsed and made a lot of money. There are examples of companies that have been sold for 800 million and 2 years later were sold back by the buyer for 30 million. So getting this timing right is, I would say, has been a very valuable lesson and will continue to be very valuable. And it's probably the same for entrepreneurs. When to enter a market, and when to adapt to new technology, when to double down on hiring more people, which increases the burn. But if you do it well, it might help you to raise more money at a higher valuation. Getting that right is an art.
As an investor, did you then, after those timing mistakes, any kind of tools, and I'm speaking in the broadest sense, it might be as easy as like a to-do list or a checklist to kind of keep you from at least, like stepping out of it. There's like all those, there's habit forming, there's many things like, am I doing this subconsciously or am I making a conscious decision? Do you have developed anything like that you say, okay, before I take an investment or before I give up on a company, I check those 5 topics, and if they all are red or green or whatever, then I say, okay, I'm stopping or I'm taking a step back?
Yeah, so some things are more soft, like on the people mistakes we made. So in the beginning, that's part of our background, we thought that if certain things, the management felt differently or there was a gap in the team, we thought we could help them, or we can discuss that later. So we're not making any compromises anymore there. If something doesn't feel good, intuition on the team, or you feel that there are gaps, or we have a significantly different view on where the opportunity is, you quickly get in situations where people all agree that they will do it and we sort it out later. So if that gut feeling is that that's not there, we're not going to compromise, we will not invest. Then on the checklist, etc., I think part of our moving up a little bit the revenue threshold of the companies we invest in from very early with no revenues to 500,000 and 2 million is also that there is way more clarity on what, at least what we see in companies with 2 to 5 million. It's clear whether this is a team that can also hire and manage other people, and whether it's a team that can not only develop a new product, but can also sell and scale a product. There's more data to see whether customers really like it. In B2B, if you get a pilot from a very big, one of the top 50 banks, you could easily get a contract for 500,000 or 1 million. That's like a pilot. But whether you can really then have a product market fit, or whether you really get multiple clients that are interested in this product, or you just happen to have one client, that's what we all feel is easier to judge at this 2 to 5 million level.
Now, before we wrap up, I found one interesting thing, and it brings me to our typical last section of the day, and that's you are holding 4 master's degrees. And that kind of like brings me to how important in your hiring. So if you're looking for a new investment manager, if you're looking for a new partner, how important is kind of like university education versus real life, like street smarts? Because I also saw you also, before you started, founded 3 companies, right? How do you value those kind of skills, and what skills would I need to bring to the table to get a job with you?
Yeah, so first of all, we work as a team. So we try to look also what does the new person bring to the team that overall makes the team better. So we're not looking for 20 identical people, because probably we could have been as good with 18 or 10 of these people, because they're all the same. So we look at, do people bring a different network? Do people bring a different lens? So we now have in the team people that worked in companies in the area of product. Some people worked in the area of technology. Some people have founded from start to finish their own companies. Some others have been investors or built their own companies. So it is important that people come with a different lens. Okay, a constructive lens, like if one hates investing and the other one likes investing, that's not necessarily a helpful other lens. Then age is for us not an issue. Okay, probably unlikely that we hire as an associate someone who is 65, but we're not focused on that. I think for the junior roles, if it's like business analyst, I think it's people need to be open enough to maybe learn new things, which is some age people have used and got familiar with a certain way of working. So that is important there. Then geo networks, as we're an international firm, personality. So we also do tests in the beginning to see some people are more introvert, other people are more execution, other ones are more reflective. That's for us. We like the different personality styles. Also, I think a lot of founders are different. So that we also have different personalities that can be a good match with the companies we invest in. Academics, I think, is we look at it, what grades people get and what they did, but it's more are people focused on getting the best out of their skills is more important. And it could be that someone has done great sport achievements in combination, or people have worked in amazing companies. So academic is an element, but it's not, especially for all roles after associate and business analyst. I think the academic, I'm not even sure I know the academic achievements of most of my colleagues.
Okay, perfect. Radboud, that's all the questions I had. If you want to have any last words, be my guest. Otherwise, thank you so much for coming on the show. It's been very insightful, very interesting, and I wish you all the best of luck for your next fund.
Thank you. Thank you very much, and thanks for a great interview.
Hey again, this is Andy. I hope you enjoyed the episode. If you did, please leave us a 5-star review on Apple Podcasts or wherever you get your podcasts from. Share the episode with your friends, with your colleagues, and everybody that is interested. And if you want to reach out, feel free to drop us an email, a message on social media. And I look forward to hearing your thoughts, your comments, your feedback. And thanks again for listening. Have a great day.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.